Principle 2, build your own capital. You see, I can attribute all of my successes and business failures to one common denominator, cash. If you do not properly build net operating cash flow, you will at some point run out of oxygen, maybe become over-levered going to banks or investors, and you'll violate Principle 1, protect and grow your equity. Let's grow to 100 million, or let's build this grand business is a fantastic vision, but how are you going to fund this? Alan Miltz, the co-author of the Cash chapter in Scaling Up, talks about this saying, revenue is vanity, profit is sanity, cash is king and queen. If we had 100 entrepreneurs in this room and I asked everybody who manages their business on a monthly basis based on their profit and loss statement, 99 out of 100 hands would go up. And by the way, so would have mine. But Alan Miltz says, wait a minute, just measuring your business's performance based on your profit and loss statement is like reading the first chapter of a murder mystery novel and knowing how the whole book's going to end. It doesn't work that way. Some companies and entrepreneurs look at their balance sheet, which is a little bit better, but you need to know your net operating cash flow. Don't be afraid to look. It's the most important metric you can actually measure. Alan Miltz interviewed 3,000 CEOs, and not one of them could tell them how to calculate net operating cash flow properly. I know I couldn't, and I bet you can't either. In the $100 million journey, we review the exact formula on how to calculate your net operating cash flow, and we provide a $100 million journey workbook that will give you an exact Google Sheet or Excel to punch in your numbers and calculate how much cash your business is generating. You see, a lot of entrepreneurs brag about their revenue or how much money they raised. They rarely talk about their profit, and they never talk about their cash because quite simply, they don't even know how much cash they're generating. You see, for myself, when I experienced one of my biggest business failures, we were generating enough cash. We were reinvesting it, though, carelessly into other areas, which would then reduce our net operating cash flow. So we were growing ourselves poor. You don't want to be in that position. There are 4 tools I talk about in the book to help grow your net operating cash flow. One is the cash flow ladder. So think about the different segments of your business that you would like to evaluate. As an example, we did one on our customers. We took all of our top customers and we evaluated how much cash flow are these customers generating. What is the marginal cash flow percentage these customers generate for us? What we found was some of the customers we thought were our best customers were actually our worst performing cash flow customers. They were hurting our business and affecting our ability to generate net operating cash flow in order to grow. So we had to tweak them. One of the ways we tweaked our customers was with the power of one. Power of one is a model, again, from Vern Harnish's Scaling Up. Him and Alan Miltz in the Cash chapter talk about the power of one and how 1% changes in your business, whether it be pricing or cost of goods sold or overhead or 1 day changes in AR or APs can really augment your cash flow of your business and help your customers or segments of your business become more profitable to generate more net operating cash flow. The third opportunity that we look at to grow your net operating cash flow is to know your self-financeable growth rate. There's a Harvard Business Review. How fast can your company afford to grow? Do you know how fast your company can afford to grow? Because I sure didn't. I would always go out and say, hey, let's grow to 20%. Next year, everybody, we got to grow 20%. The problem is I didn't actually realize that our self-financeable growth rate would tell us, based on our net operating cash flow, that we can only grow 5%. So where does that other 15% come from? Where's that other 15% of cash that you need to grow come from? Well, guess what? It came from bank debt. It came from going to get investor capital come into our business, and that would violate Principle 1, protect and grow your equity. So you need to know how fast your company can afford to grow, your self-financeable growth rate. And the fourth one is the 3-year capital strategy. Jeffrey Unger, the founder and CEO of G2 Capital Advisors, has never met a CEO or an entrepreneur who can tell them very specifically what their 3-year capital strategy is. And again, I knew I couldn't. But if you want to grow 20% and you can only afford to grow 5%, where's this other 15% coming from exactly? If it is coming from banks, that's okay. But how are you going to pay that back? How are you going to grow your net operating cash flow to further increase your self-financeable growth rate so at some point you can actually grow 20% on your own cash flow? Where are you going to spend the money? What are the resources you need to invest in order to grow your self-financeable growth rate to get to the 20%? So what is your 3-year capital strategy? And again, we provide an exact worksheet on how to calculate that 3-year capital strategy in the $100 million workbook. Growth takes cash, and you can be a victim of your own success. If your business is so successful that it's growing, but you're going way too far above your skis, and you have to go hat in hand to investors and financiers to grow your business and violate principle one. Without cash, your business can die. We need to win at the game of making cash. We need to build our own capital.